The KAJBS group is committed to ensure our clients are updated of the latest clarifications issued by the authority. And we therefore have you all here at yet another webinar on the UAE Corporate Tax series, focusing on the latest guide on free zone persons as well as other important updates. With this note, I'd like to introduce before you our speakers for the day. It's my privilege to introduce before you Mr. Vipul Kothari, the founder and head of KA and GBS. He has the distinction of passing the Chartered Accountancy at the age of 21 from the Institute of Chartered Accountants of India and went on to receive gold medals from BK School of Business Management in MBA Finance. We also have with us Mr. Prasad Bhonde, Director, Audit and Tax. He is a company secretary in addition to many more professional qualifications and has over 20 years of progressive experience in the professional field. We also have with us Mr. Kapil Sheth, Manager, Tax and Corporate Compliances, who will be joining us during the panel discussion at a later part of the session. He is a chartered accountant and has over 11 years of experience in the field of international taxation and corporate tax in India and Oman. Before I hand the session over to the speakers, please note that the session is being recorded and all the participants are muted. In case you have any questions, please raise them in the chat box and we shall answer them at the end of the session. So without delaying any further, let's move on to the session. Over to you, sir.
Thank you, Jyotika, for the introduction. Welcome everyone to this webinar on corporate tax in UAE. This is a series of various webinars that we've been continuously doing on different aspects with respect to corporate tax in UAE and the intricacies of the corporate tax. Taxation of free zone persons is a very important aspect. In general, if you see, corporate tax is not so complicated as far as mainland entities are concerned, which are subject to 9% taxation, and the expenses are mostly all deductible except for few which are non-deductible or partly deductible, and that list has been provided and the clarifications and guides also have been issued on that. So except for transitional provisions with respect to mainland companies, there are no major complications that we see in that. However, free zone taxation is a little bit a complicated scenario, and various ministerial decision and cabinet decisions were issued with respect to the free zone taxability and what would be qualifying and non-qualifying income, and how the calculations would be done as far as the free zone taxation and the taxable income would be there. So today in this session, we will cover on the taxability of free zone person. And then offshore companies is another important aspect of, various corporate holdings where many entities or groups have offshore companies in their portfolio for holding of assets or investments. Whether those would be in UAE or overseas. So how they would be impacted with this UAE corporate tax. And lastly, on the corporate tax registration timelines. Obviously, that has started, and there are timelines which are specified based on your incorporation and license dates. So that will be covered, because if we fail to register on time also, there are penalties involved. So I'll first start with the qualifying free zone person taxability, and we'll call it as QFZP. Now, there are various conditions to be fulfilled. What primarily would be required is, first, every company which is operating in a free zone will need to confirm with their free zone authority that yes, they are qualifying free zone and they would be entitled to the tax benefits. Because what the tax law says is that this benefits would be granted to free zones subject to the remaining period of benefits which are granted and confirmed by the free zone authority. Now, free zone authorities, whenever they were formed and established, they've given tax holiday ranging from 15 up to 50 years. Now, that could be from the date of the establishment of that free zone or from the date of incorporation of the company. So what is the remaining period which is available, that needs to be confirmed. Unfortunately, till date, I think none of the free zones have really come out with this clarification, and the tax authority also is not probably currently they have not issued any clarification on this, that which free zones will be entitled. Our understanding is that currently all the operating free zones in UAE should be covered under this, and they should be entitled. However, it is still necessary that you should check with your respective free zones on the applicability and the benefit that it would be granted if you are operating in that free zone. Second aspect that is required is you need to maintain adequate substance in the free zone. Now, this would mean, now I'll cover all these in the subsequent slides, that, each of these points. Then the third point, or the third condition to be called a qualifying free zone person, is that you need to prepare audited financial statements. Fourth condition, you have to comply with the transfer pricing and arm's length pricing requirements on transactions with related parties or with connected person. And such free zone companies or free zone person should not have elected to be subject to normal corporate tax regime, because the tax law permits that any free zone company can opt for going for benefit under the qualifying free zone person regime, or they can opt for a normal tax regime of 0% up to 375,000 and 9% beyond that. Another condition is that the free zone person should derive qualifying income, and we'll look into that what is a qualifying income. And the last one is that they should meet the de minimis test. Now, this becomes more technical, the qualifying income and the de minimis test. The remaining are probably not very difficult. Of course, transfer pricing and arm's length pricing could be difficult to meet, but not very difficult to understand, I would say, in the initial stages. So, as I mentioned, you should be a juridical person, meaning you should be an incorporated entity in a free zone, registered in a free zone. And that would include even if you are as registered in a free zone as branch of a foreign company or a local company. Now, as I mentioned, you need to clarify with your free zone that yes, it would be entitled to this benefit. And also, if you are carrying out certain activities, you need to also understand and confirm that is your company falling in a designated zone or is it in a normal free zone? Designated zones are the ones which have been defined under the VAT law, and there's a list available under the VAT law. Designated zones are primarily ones which are fenced free zones, where the goods in and out happens through a customs checkpoint, or entry and exit even of individuals happens through the checkpoint. So it should be a free zone person. This is the first condition. Second condition is you have to maintain adequate substance. Now, what do we mean by substance? You need to primarily, one, undertake core income generating activities. SIGA, as we have put the short form here in the slides, it means core income generating activities, which would mean that if you are a trading entity, for example, your core income generating activities technically would be procurement, marketing, logistics, supply chain arrangements and all this. These primarily would be your core income generating activities, because only if you carry out these, you would be able to generate revenue and income. And other activities could be as non-core activities, which would be primarily, let's say, bookkeeping, accounting, or administration, HR. Those could be non-core income generating activities. So what the law says is that core income generating activities should be carried out in the free zone. And if you are operating in a designated zone and you are carrying out distribution activity, then you need to carry out such core income generating activities in such designated zone only, and not in any other free zone. However, you can outsource the core income generating activities to any other company also, but again, that should be carried out in the free zone or designated zone as applicable. Non-core income generating activities could be outsourced anywhere else primarily. So, that is required. And substance also would mean that you should have adequate employees, adequate infrastructure in terms of assets, and adequate operating expenditure also should be there. And this will be more or less, similar to what is mentioned in the economic substance filing also. So this is one major thing that needs to be taken care of. So primarily companies which are only mere postbox companies, which does not have an office, which does not have employees and team to handle operations, and only transactions are being done, as a pass-through transactions, will not qualify for availing this benefits. And bear in mind that out of all these conditions, even if one condition is not fulfilled, you are disqualified from claiming the free zone person benefit. Another condition is you have to maintain audited financial statements, which is mandatory for claiming the free zone person benefit. And these have to be prepared irrespective of whatever revenue that you generate. However, it does specify that if your revenue is more than 50 million dirham, full IFRS is mandatory as an accounting standard. But if you have revenue which is less than 50 million, then you can opt for IFRS for SME. So that's on the audit part. Another condition is you have to comply with the transfer pricing and arm's length pricing requirements. This would mean that any transactions with related parties, and bear in mind, related parties have been again defined very widely in the corporate tax law. It primarily says that related parties could be one which are up to fourth degree of kinship. So fourth degree of kinship, to that extent, if there are companies and entities where the shareholders, owners have fourth degree of kinship, those would be considered as related parties, and any transaction with them have to be on arm's length basis. There are various formulas or various methodologies which have been defined by the law. And so you could go on any of these which truly reflect the nature of transaction and business. If you have a domestic or a foreign PE permanent establishment, meaning if a free zone company has a branch in mainland or a branch overseas, those also are considered as related parties, and that would also need to be transactions will have to be on arm's length basis. Sorry. And whatever transfer pricing compliances are there with even connected persons have been defined as shareholders, directors, or any officers of the company who are involved in the management and operations of the company. They are technically considered as connected persons. So any payments to them also, whether it is by way of remuneration, whether it is by way of interest or any other mechanism, that also should be on arm's length basis. So again, if this is not fulfilled, you fail the arm's length principle, and you fail the transfer pricing requirement. You technically fail the test, and you cannot claim the free zone benefit. So sorry. On the normal tax regime, as I mentioned, there is an option that even free zone person can opt and say that, okay, I do not want to claim free zone benefit. I'll pay the normal tax rates of 9% above 375,000 dirham. That option is available. However, if any company which chooses, a free zone company which chooses to go for normal tax regime, they technically become disqualified for claiming free zone benefit, not only in the year in which they claim this normal tax regime, but even the subsequent 4 years. So technically 1 + 4, 5 years, they become disqualified. So this again is one condition, that you should not have opted for normal tax regime, and you should have opted for a free zone option or regime for taxability. Now here comes the most challenging and difficult part, which is the qualifying income and the de minimis test, the last two of the conditions. Somehow what feels like, when you see this and read this entire thing and go through, it feels it has become quite technical and challenging in terms of not just accounting, but in terms of accounting and thereafter computation of taxable revenue and classifying it as qualifying or non-qualifying, and then fulfilling this de minimis test. Now, what this de minimis test briefly mentions is that you have to segregate your revenue into primarily 3 components. If you see on the right-hand side of the slide, your revenue gets segregated into three components. One is revenue, which will be taxed at 9%. So revenue which will not be considered part of qualifying or non-qualifying revenue, but it will be directly taxed at 9%. And this will come to in the subsequent slide, that what is that taxable at 9%. After you remove that revenue which is at 9%, the remaining revenue has to be classified into qualifying and non-qualifying revenue. And we'll come to this de minimis test calculation in subsequent slides. So the first thing that you need to do is that if as a free zone company, you have a domestic permanent establishment, meaning you have a branch in mainland, for example, that income would be taxable at 9%. Now, when I say income here, you have to consider the fact that it's not only the gross revenue, but it is a taxable income. So whatever is the profit from that branch, domestic branch, will be directly taxed at 9%. Or if you have a foreign branch also, that would be taxed at 9%. Or if you have an immovable property in free zone, and again, if that is not qualifying income, meaning it's not a commercial property with transaction with free zone, it would be taxed directly at 9%. So practically any immovable property in free zone where transaction is with non-free zone person and it's not a commercial property, it would be taxed at 9% directly. So any profit from this will be taxed, all of these. And even the last one is income from ownership and exploitation of intellectual property. So if you have an intellectual property, there is again another set of technical calculation that needs to be done, out of which certain component will be, based on that calculation, will be called a qualifying income, and remaining will be directly taxed at 9%. We are not going much into detail because for, I think, the participants today, this may not be so important. Now, on the property part, if we look at the first component that we have to segregate, if you have an immovable property, I think this chart will make it more clear that you either have an immovable property in a free zone. So then you need to check whether it is a commercial property or a non-commercial property. If it's a commercial property and your transaction, meaning you leased it out to another free zone person, that technically becomes a qualifying income, and it could be subject to then 0% tax. However, if you have leased it out to a non-free zone person, as you can see here, that would be taxable income at 9%. And all the non-commercial property in free zone also would be taxable at 9%. However, if a free zone company has some immovable property outside the free zone, that becomes completely excluded activity and it would be treated as a non-qualifying income. So practically, commercial property or non-commercial, so any immovable property, you'll have to, based on this, determine that what would be taxable at directly 9%, or it would be as a qualifying or non-qualifying income. And if it is a qualifying and non-qualifying income, then obviously we have to go through that de minimis calculation. I think this example would make it a little more clear. If you see in the first chart on the left-hand side, where a free zone company is holding a commercial property in a free zone and it has leased it out to a free zone person, it would be considered as a qualifying income. However, if it is leased out to a non-free zone person, it would be subject to 9% tax. So taxable directly at 9%. Now here again, when I say it would be taxable, would mean that your whatever is your revenue, rental income, less the cost associated with that rental, maybe maintenance charges, service charges, or any such cost. So net, what is your net revenue in that, or net taxable income, that would be taxed at 9%. If you have a non-commercial property within the free zone and you leased it out either to a free zone company or to a non-free zone company, it would be taxed, both would be taxed at 9%. The last on the right-hand side, the chart which is there, that is for the properties held outside the free zone. So if you have a property which is outside the free zone, immovable property, and it is leased to any one, whether it's leased to a free zone company or a non-free zone, it would be considered as excluded and it would be covered under the non-qualifying income. And then non-qualifying income calculation of de minimis test it would be used in. So this, I think, would make on the property holding clear. So this primarily says that if any free zone company has immovable property which are outside free zone, it would go under non-qualifying income. And when the ratio of non-qualifying income goes to 5% of your total revenue or 5 million dirham, you could technically get disqualified from claiming the free zone benefit. So this primarily is a disadvantage of now holding an immovable property outside the free zone within a free zone company. So if a free zone company holds a property outside the free zone, it practically would be at a disadvantage. Intellectual property, I'm skipping for the time being. If anyone has specific queries, we can really take it up later. So once you've excluded mainly the income from your local branches, which would be taxed directly at 9%, your foreign branches, which would be again taxed at 9%, and your immovable property related income, which could be taxed at 9%, or it could go as a non-qualifying income or a qualifying income. The remaining revenue, primarily, we need to then look at and see that does it fall under the qualifying revenue or does it fall under the non-qualifying revenue? Now, how do you determine what is qualifying and what is non-qualifying? The first check that has to be done is that is your company selling goods to another free zone company? Now, if your company is selling, if your company is a free zone company and you are selling to another free zone company, and that another customer which is in free zone, who is your customer residing in free zone, is the beneficial recipient, then technically that would be as a qualifying income. Of course, again, we have to check that the activity that you are doing is not falling in the excluded activity. Now, there is a list of excluded activities which we'll go through later. So what is important to note first here is you have to identify that is your customer a free zone person or is that customer a non-free zone person? Now, if that customer is a free zone person, you then check that is that customer a beneficial recipient, meaning is he buying on his own account and acting independently, or is he acting as an agent on behalf of someone? If he's acting as an agent on behalf of someone, technically he may not be then deemed as a beneficial recipient, and then you do not get this benefit of qualifying revenue for that sales. So the important part here is now you will have to check with your customer to whom you are selling that is he the beneficial recipient. And for that, what you need to do is take an undertaking from them that they have a right to use and enjoy this goods and services, and they have a right to even sell it to any person that they desire. And they're not legally bound or contractually bound to supply goods to only one person. So that undertaking has to be obtained and kept in your record. Otherwise, it would be difficult to prove. And after checking the beneficial recipient, you also need to check that whether the activity that you are doing, the transaction, which is goods or services, is it not falling in the excluded activity? If it is not, then it is called a qualifying revenue. Second aspect is if your customer, first we saw that if your customer is a free zone, what are the applicable rules? If your customer is a non-free zone, then you have to check that does the activity that you carry out or items that you're selling, does it fall under the qualifying activity or not? And also that it is not in excluded activity. The last one, qualifying income from IP asset, again, I'm skipping right now as it's not very relevant to our set of participants today, but I can again take questions in the Q&A on that. And then any other income which is there which meets the de minimis criteria, so which is 5% of your total revenue or 5 million. If it is within that parameter, then that also would be considered as a qualifying income. Now let's look at primarily what is of course, this is non-qualifying. So whatever is not qualifying income, would now be considered as non-qualifying. So we'll go to what is the qualifying activities, which is very important, specifically when you are doing transactions with non-free zone persons. Now, if you are selling goods to non-free zone person, you primarily can only carry out these activities, which is manufacturing of goods or materials, processing of goods, holding of shares and securities, ownership, management and operation of ships, reinsurance, fund management, wealth management, headquarters services, treasury, financing services, financing and leasing of aircraft, logistics, distribution of goods. So, and of course, there are ancillary activities to the above. We'll go into little more detail on some of these qualifying activities which are more relevant. So first one, distribution of goods and materials from a designated zone, because this is very important from many of our customers, clients, who are operating in free zone and they are into distribution of goods and material. So what it says is, when you are doing distribution, so practically, let's simplify it and say it as a trading. So you are doing trading of goods. You're not doing manufacturing or services. You are only doing trading. Now, when you're doing trading, it should be from a designated zone, unless you are trading in qualifying commodities, which could be from any free zone. So if you're trading in distribution of goods and materials, now that could include buying and selling of goods, materials, or anything, and it could include import, storage, inventory management, but it just says it may include. So it is not necessary that you should import it in UAE and then sell it. You could also do a high sea sales. And I'll go to the examples of this, so that would make it a little more clear. The only check here, or the only point that you need to make sure in this is, one, the good distribution of goods and materials should be in or from a designated zone. Meaning, if goods are imported into UAE by you, you should do it through a designated zone and not any other free zone. Second point is, customer to whom you are selling, they should be reseller of goods, or they process and alter such goods, materials, or parts thereof for resale. So if you sell to an end consumer, then technically you cannot claim this benefit under the distribution of goods or material. So this distribution activity could include any of this, not necessarily that all of this would be there: purchase and resale, warehousing, transport, delivery, logistics, inventory management, order processing, or packaging. And there are ancillary activities. If you are doing some quality control, inspection, or support services, which are part of your contract with the customer when you sell the goods, that would be considered as ancillary activities. So that would all get covered under the qualifying income. Now, there are various scenarios, examples, I think, which would make it more clear that high sea sales, if you are doing, so manufacturer, you are a company C based in a designated zone in UAE. In this chart, if you see at the bottom, you are buying from a manufacturer in country A, or it could be trader in country A, anyone. He sells the goods to you, you bring it into the, you are not bringing it into the UAE, you just buy the goods from him. That manufacturer directly supplies it to a distributor in country B. So it's an high sea sales or a third port shipment. You are only processing the document where purchase is done by you, and then in turn you sell the goods. You receive money from the customer, and you in turn pay to the supplier. So though this is high sea sales, goods do not enter UAE, but since if you are based in a designated zone, this would qualify as a qualifying activity. There's another scenario where goods are imported into UAE through designated zone, and then they are sold whether within UAE or outside. So you again, as a customer, company D based in UAE in the center, if you see, you are buying from third country goods. Goods are practically coming into UAE. If they're coming into UAE, it has to be imported into a designated zone, and then it gets sold to end retailer or distributor within UAE, or it could even get sold to anyone outside UAE. This would also be a qualifying income. The third scenario, you are again a company based in UAE in a designated zone. You buy goods from a manufacturer or a trader in UAE who would have imported it. He in turn directly delivers to your customer. Only the billing happens to you, and you in turn bill to the customer. So this also would be considered as a qualifying activity, and these have been clarified in the guide which has come. This scenarios are given in the guide, and this has been clarified that these are all going to be considered as a qualifying activity. So a designated zone carrying out these activities would be able to claim the benefit. One very interesting scenario also is the last one, that you are a UAE company based in designated zone. You buy from a manufacturer or a trader in UAE, and you sell also to another retailer or distributor in UAE. Goods may not come to designated zone. It goes directly from the supplier to the customer. And despite that also, it would be deemed as being carried out in or from designated zone, and it would qualify as a qualifying income, and you can claim benefit. Now, this is a very interesting option available to many of the distributors and traders to look at their business operations and see how to utilize these benefits which have been granted for the distribution for the free zone companies, and especially designated zone companies. So what needs to be kept in mind for distribution is that it's not necessary goods or material to physically enter the UAE. It could be high sea sales. And if it is within the UAE, already goods are within the UAE when you have purchased, at that point in time also, it is not necessary that from UAE mainland it has to go to the designated zone and then only get delivered or distributed to the customer. It's possible that from UAE to another customer in UAE, it can get distributed, and documentation and the sales could actually documented through the designated zone company. Written undertaking from customers is necessary so that goods are not for end use, they are not for self-consumption, these are for resale or distribution. Logistics service is another as a qualifying activity. So that would include storage, transportation of goods or material on behalf of another person without taking title of the goods. So that would include transportation, warehousing, inventory management, all documentation, freight forwarding. So this is a big relief, I would say, for many logistic entities. If they're based in a free zone and carrying out their business from free zone, they would be entitled to claim the free zone person benefit and be eligible for 0% tax if they fulfill all the other conditions which are required under the free zone regime. Manufacturing of goods or material. If you are again in a free zone and manufacturing goods or material, again, you would be entitled to benefit under the free zone regime. And what it would include is production planning, production quality control, all that. I'm not going into much detail because these are self-explanatory, and we will circulate the slides after the event. There's one more activity which is considered qualifying, which is processing of goods or material. So the earlier one was manufacturing, where we were manufacturing, and this is processing, where it is more as a treatment, transformation, or conversion of goods or material into another form. So it's not complete conversion into a different form. It is basically processing and converting it into a different form. That would also get covered under the qualifying activity and be entitled to 0% tax, provided again they fulfill all the other conditions. Holding of shares and securities is one very interesting activity available under the qualifying activity for free zone companies. This would mean that any company which holds shares and securities as an investment, it clearly mentions as an investment. This investment, holding for investment, would mean you have held it for 12 months or you have an intent to hold it for 12 months at least, minimum. So day trades or short-term trades will not get covered under this. But if you are looking at holding the investment for a longer tenure, 12 months or more, that would get covered. And any form of securities, which is negotiable, non-negotiable financial instruments, including derivatives, even cryptocurrency or other investment instruments, they are all covered, provided they are traded on public or private market. And you need to hold it for 12-month period. Transaction, so this primarily would exclude any active trading of shares and securities. And of course, if you are a shareholder, and normally as a shareholder, you only receive dividends and capital gains, only that income is included as qualifying income. But if you receive royalties or management fees in your capacity as a shareholder, that is not considered a qualifying income. Headquarter services is another qualifying activity where one free zone company is giving services which could include provision of management personnel or insurance, admin service, procurement service, planning, business planning, development, risk management. All of those could be treated as providing headquarter services being granted to related parties. Now, such related parties can be within UAE, or they can be outside UAE, within the free zone or outside free zone. These are all considered as HQ services, and they could be considered as a qualifying income, subject to, again, fulfillment of the conditions. Now, what it would include and what it would not include is given, which will circulate in the slide. Treasury financing services is another aspect where one company is managing the funds and finances of their group, and they are providing liquidity, cash, or financing to the group companies, and then they are charging interest. That also would be considered as a qualifying activity. So one more interesting addition which has been done and clarification which has come in the guide is that if you have surplus funds when treasury activities are being done by one of the company, obviously if there's surplus funds, that could be deployed as a bank deposit. So interest income on such bank deposit also would be considered as part of treasury financing, and they would be qualified as qualifying income. Qualifying commodities is another activity. So if you are doing physical trading of qualifying commodities, now what qualifying commodities have been specified are metals, minerals, energy, and agricultural commodities. Only these four categories of commodities which are traded on a recognized commodity exchange market in a raw form. So practically, if you are trading in any such commodities, the requirement is that you need not do your transactions through the commodity exchange, but that product that you are trading in should be traded on a commodities exchange. Then only it would be considered as a qualifying commodity, and it should be in a raw form, meaning in natural unprocessed state, with no added value after it is extracted or mined, except some minimal processing is being permitted. Like, let's say raw gold is converted into a gold bar, but it is in its pure form, 99.9% purity. That would be considered as a qualifying commodity. Now, if you are carrying out this activity from a free zone, any free zone, it would be considered as a qualifying income. Ownership, management of ships, financing, leasing, reinsurance, we are skipping because those are not very relevant to our, again, this participants. Then there is fund management, wealth management services also. Now, both of these, if you see, they have to be regulated, meaning they should be licensed by either DIFC or ADGM or Central Bank or ESCA. and any such companies which are from free zone carrying out these activities, they could claim the free zone person benefit of 0%. Now, we had also seen that excluded activity primarily would be needs to be looked at. So specifically, when you are doing transactions with free zone person, you need to check whether the activity that you are carrying out is excluded activity or not. And this is a list that if you are doing any transaction with natural person, except certain activities, banking, insurance, financing, these are excluded, which you should not be carrying out. So whenever you are doing any activity, either with free zone or non-free zone person, you need to check whether it is not falling in the excluded list of activities. Now, once you have gone through this, you are classifying. I'll go directly into the de minimis illustration primarily, I think, to explain better. As I mentioned earlier, your total revenue, whatever is there, you need to classify into 3 sections. One is taxable revenue at 9% directly. So in this example, if you see, they have revenue from domestic P, which is, let's say, domestic branch in mainland, 10 million. That would be taxable directly at 9%. Of course, not entire 10 million less whatever is the attributable expenses of that branch. So whatever is the profit of that branch, that would be taxed at directly 9%. Same way, if there is rental income of property, as we saw in earlier slides, that rental income, certain rental income, which is transactions with non-free zone person and property being in free zone, that would be directly taxed at 9%. So that becomes taxable. You remove that component. The remaining ones, if you see, that you need to then segregate it. That you need to segregate it into qualifying and non-qualifying. So the third item, the third row, if you see, revenue from free zone person, which is also not an excluded activity, that would go under qualifying revenue. However, if you have some revenue from free zone persons, but it falls under excluded activity, which is 200,000, then you classify it under non-qualifying income. Then third category is you have revenue from non-free zone person, which is qualifying activity and it is not excluded, 2 million, that goes under qualifying then. And if you have revenue from non-free zone, but it is not a qualifying, it goes under non-qualifying. Now in this, if you see example, your qualifying revenue is 6.8 million. Non-qualifying is 500,000. So your total revenue for de minimis calculation will be 7.3 million, which is total of 6.8 and 500,000. So practically your non-qualifying income is 6.85% of your total revenue for de minimis. Now, if this is 6.85, this would mean that you have failed the de minimis test and you cannot claim the free zone person benefit. This ratio should be, the non-qualifying income should be 5% or 5 million, whichever is lower. That is the requirement. Another example, again, here we are only looking at qualifying and non-qualifying. Taxable income, which was taxed directly at 9%, we have removed. So first, you just see that have you done transaction with free zone person and is he the beneficial recipient, that free zone person? It goes as qualifying revenue. 1.2, your transactions with non-free zone, you'll have to check again that this transaction, the goods are sold for consumption by the customer. So he is not a reseller, he is the end consumer. Then it goes as non-qualifying, the 50,000 that is put in that particular row. The next, if it is for resale, where the goods imported into UAE through designated zone. So if goods have come to you, did it come to you through designated zone, then it goes as qualifying. But if you have imported it through mainland or some non-designated zones, then it will be as non-qualifying. If you have purchased from within UAE, free zone or mainland, again, it would be as qualifying, and high sea sales also qualifying. And then you have some service revenue, which is transactions with free zone company, which will be qualifying. And if you have transactions with non-free zone for service revenue. So if you are raising some or rendering some service from free zone to non-free zone company, it would be as non-qualifying. So in this case, if you see, your qualifying revenue comes to 15.990 against non-qualifying 550. So the percentage of non-qualifying is 3.33. So you can claim the free zone person benefit, again subject to fulfillment of all the other free zone conditions. This is in brief nutshell on the free zone benefits. Of course, once you opt for a free zone person, you cannot carry forward any tax losses, or I mean, you cannot transfer the tax losses to any other person, or you can't even accept the tax losses. And even tax losses pertaining to your qualifying income cannot be set off or carried forward, because practically you have not paid tax on it. It is 0%. So how you can then set it off in future years? Only the taxable income which we saw directly taxed at 9%, loss relating to that, if there is any, that can be carried forward and set off against future such taxable income. Benefits, I think 0% tax benefit is the biggest benefit, of course, if you claim QFZP benefit. However, the obligations and the downside sometimes could be that there are a lot of conditions that needs to be fulfilled, and if you fail in any one of the condition, you cannot claim the free zone benefit for not just that 1 year, but even subsequent 4 years. So you lose out on that. And then, of course, free zone companies, if you are claiming that, you cannot be part of a tax group. And obviously, the threshold of 375,000, 0% would not apply. So this is in brief about the free zone person benefit. I'm sure, I think there would be quite a few questions, which we'll take in the subsequent Q&A session after the next presentation. Thank you very much. I know it was little more technical, and it is because free zone benefit is a technical thing. And unfortunately, the way that it has been drafted and the way it has come out, it is little complicated. And that's why every company which is aiming to opt for a free zone person benefit needs to take care and ensure that their accounting records are from very beginning segregating their revenue into different categories. That are they qualifying revenue? Is it non-qualifying revenue? Is it from excluded activity? Is it taxable at 9% directly? So you need to, from beginning, have those groupings and proper chart of accounts to ensure that at the end of the year, you do not have to do that exercise. And another thing is, in this, you need to continuously keep on monitoring that whether you will be fulfilling the free zone person requirement of de minimis or not. So on a month-on-month basis, our suggestion would be that you should monitor your QI, qualifying income and non-qualifying, and calculate the de minimis criteria, that have you fulfilled or not. Because if you are going above that, then you will not be able to claim the 0% benefit. Thank you very much for your presence and patient listening. And questions we'll take in the next session. I'll hand over to Prasad Bhai for the next part of the session. Thank you.
Thank you, sir. I will just share my screen. Is my screen visible?
Yes.
So thank you, Vipul sir, for a very insightful presentation. It was quite detailed. As you said, yes, it is QFZP is a complicated and a technical issue. So every company has to do their analysis based on their accounting data and transactions in order to arrive at whether they would like to go for the QFZP exemption or not, because the choice will be very important, and which will impact not only this tax period, but also future tax periods. So having said that, I will take a brief presentation on the taxability of offshore companies and the registration, corporate tax registration timelines. There has been a lot of debate and a discussion within the fraternity as well as clients saying that we are offshore companies and we have no operation in the UAE. and we are not subject to tax, or we don't need to do anything as far as CT is concerned. So let us analyze as to what actually it is. So if you see, there is a flow chart on the screen where the taxability of offshore company becomes quite clear. So offshore companies we can bifurcate or segregate into two parts. One are UAE offshore entities, those who are registered in the UAE in either Jafza, RAC, ICC, Ajman Free Zone, who are registered with some UAE Free Zone authority. And there are obviously foreign offshore companies who are not registered in the UAE, they are registered out of UAE. As far as UAE offshore companies are concerned, they are considered as a resident person. So since they are registered with the UAE authority, they would be considered as a resident person. And unfortunately, they will not be given any free zone benefit, or will not be eligible, I would say, for any free zone benefit, because they would not be able to prove any substance in the UAE. They would not have an office, they would not have adequate staff. Their operations might not be here. I mean, the management might not sit here. So in that case, they are not satisfying the basic requirement for qualifying free zone benefit. And hence, unfortunately, they will not be eligible for the qualifying free zone exemption. And since they are a registered person, they would have to do the UAE tax compliance, such as corporate tax registration, return filing, and if any taxable income, then tax payment as well. So a registered UAE offshore company will be under the ambit of corporate tax and will have to do the necessary tax compliance. As far as a foreign offshore company is concerned, who is not registered in the UAE, who is registered outside UAE, they also might come under tax ambit if it is controlled and managed from the UAE. So if suppose a UAE resident is having a foreign company which is outside UAE, and he is or she is managing that company from sitting in the UAE, then that foreign company also has to register in the UAE and follow the CT compliance regularly. In the same way, if the foreign offshore has any nexus or a permanent establishment in the UAE, then it will be also a non-resident person who has to again register and follow the tax compliance. And nexus meaning if they have some property investments in the UAE and they are generating any revenue from that, or they have some permanent establishment in the UAE, they have some branch in the UAE which is registered in the UAE, then that will also be a non-resident person. However, if a foreign offshore has only a UAE sourced income, so they do not have a nexus, they do not have a permanent establishment in the UAE, but they have just generated some income in the UAE. In that case, then CT says that you do not need to register for CT, nor you are liable to any tax in the UAE. So this is as far as offshore companies are concerned. We'll go to the next slide for the registration, CT registration. So again, if you see the flow chart here, we have distributed there are two types of persons: natural person, that is an individual, or a judicial person. So now, when is a natural person liable to register for corporate tax? So he has to obviously carry on a business activity in the UAE, some sort of business activity. Then you have to check his turnover, whether his turnover is more than 1 million or less than 1 million in the calendar year. If the turnover is less than 1 million dirhams, in that case, he is not required to register. Also, if a natural person is not carrying out any business activity, then also he does not require to register. But if a natural person is carrying on a business, has a turnover of exceeding 1 million, in that case, he has to register for corporate tax and will be liable for corporate tax. Please note that business activity does not include the income from salary, wages, or any personal investments or any real estate investments. So if an individual is holding any real estate in his personal capacity and generating rental income, that will not be considered for CT purpose. Or if a natural person is working as an employee, generating salary or getting any interest from the bank on his investments, that will not be considered for CT purpose. Now coming to the judicial persons. Those who are incorporated in the UAE, if they are incorporated in the UAE, they are treated as resident taxable persons, and obviously they will be required to register. So all incorporated persons in the UAE will require to register for tax. Those who are incorporated outside UAE, if they are managed from UAE, yes, they have to register for, for corporate tax. If they're not managed, but they have a permanent establishment in the UAE, or they have some kind of nexus, as we had seen in the previous slide. If they have permanent establishment in the UAE or have a nexus in the UAE, they have some property or something, some type of connection in the UAE, then they also have to register as a non-resident taxable person. But if they only have, they are not managing, they are not effectively managed, nor they have any nexus, nor they have any permanent establishment, but they have UAE sourced income. If they have UAE sourced income, they do not require, as we have seen in the previous slide, they do not require to register. So this is a brief of who has to register and who does not have to register. Now we'll go to the timelines for registration. What are the timelines? So resident judicial person, that is any person who, a company, you can say, not an actual person. If it is incorporated before 1st March 2024 and also has a license as on 1st March 24, then the due dates are as per the license issue date. So if a company says, say was in operation or was incorporated before 1st March, and it also has a license as on 1st March, then we have to see what is the issue date of that license, or issue month, in fact, of that license. So if that license is issued in, say, April, then the deadline is, you can see on your right-hand side, the deadline is 30th June. If it is in May, it is 31st July. So if a company in the UAE who is registered in the UAE and was in existence before 1st of March, then the deadline depends on the license issue days. If the company was incorporated before 1st of March, but does not have a license as on 1st of March, so in that case, it is usually for offshore companies who usually don't get a trade license, they just have a certificate of incorporation. Then for them, the deadline was 31st of May 2024, right? And those companies which are incorporated after 1st of March and incorporated in the UAE, so companies formed in the UAE after 1st of March, then 3 months from the incorporation date, that is the deadline. And if they are incorporated outside UAE, then 3 months from the end of the financial year. So once the financial year ends, from there, 3 months they have to register if it is incorporated outside UAE. Non-resident judicial persons, so a person who is you can say foreign company, what is the deadline for them? So again, if the non-resident, if he was a non-resident before 1st March 24, and they had a permanent establishment in the UAE, then the deadline is, registration deadline is 9 months from the date of existence of PE. Now, what is the date of existence of PE? We'll see in the later slides. If they have a nexus, a non-resident has a nexus in the UAE, then the deadline is 31st of May 2024 deadline was. And if the non-resident became a non-resident after 1st of March 24, and he has a permanent establishment in the UAE, then again 6 months from the date of existence of the PE. Now, what is the date of existence? We'll see in the next slide. And if they have a nexus, they have become non-resident after 1st of March, and they have a nexus in the UAE, then 3 months from the date of establishment of the nexus. So when the nexus was established, or you can say when they bought the property in the UAE, within 3 months, they have to register for corporate tax. For a natural person, registration for individuals, if he is a UAE resident, and the turnover exceeds 1 million dirham, as we saw in the previous slides, 31st March of the subsequent Georgian Gregorian calendar year. So they have to register before 31st March of the subsequent Gregorian calendar year. And for a non-UAE resident who has turnover who is more than 1 million, then 3 months from the date of meeting the requirement of being subject to CCCT. So when they are subjected to corporate tax, within 3 months, they have to register for corporate tax. So non-resident natural person obviously have to have a PE in UAE, and the revenue from PE exceeds 1 million dirham in a calendar year. That is a requirement for a natural person to register. So these are just the deadlines. I'll not go through that again. Yeah, one important aspect what I would like to discuss is regarding entities which are liquidating or under liquidation. Now, there are a lot of confusion that if suppose a company has started liquidation process in 24 and it might get liquidated within a month or two, does it require to register? What are the cases or what are the situation in those companies? So for that, we have just clarified that. So if entity is liquidating, if they are liquidating prior to the start of the first CT period. So suppose your corporate tax period is say Jan to December, and you are liquidating before 1st January 24. So your liquidation process has been completed before 31st December 23. In that case, you don't require registration. But if your liquidation started after the commencement of CT period, then you have to register. So suppose a company having a tax period of Jan to December, and they are going for liquidation in say March or April 24, then those companies, even though they are going for liquidation, have to register. And after getting the registration number and after the liquidation proceedings are completed, you have to deregister for corporate tax also. So that registration, deregistration needs to be done in order to comply with the corporate tax law. There is late deregistration penalty as well. You have to deregister within 3 months from the liquidation. So that also is a criteria. You have to register yourself. Once the liquidation proceedings are over, within 3 months, you have to re-register as well. Late deregistration penalty is there 1,000 per month for the number of months delay, or up to maximum 10,000. Non-resident person having permanent establishment in UAE, we had seen in the previous slides that what they have to register before 9 months or 6 months from the date of existence of PE. Now, what is the date of existence? So usually the date of existence is the date on which the PE obtained a degree of permanence. So when the permanent establishment became permanent in the UAE, that should be considered the date of existence. Right? So date of attaining a degree of permanence varies on case-to-case basis, but generally is a period of 6 months. So usually it takes 6 months time to have a proper permanent establishment. So they have given a period of 6 months unless the double taxation avoidance agreement gives a different period. Otherwise, it is a 6 months period where you can establish a permanent establishment. So once the 6 months period is over, from that, you have another 9 months to register for the corporate tax. And also just a small reminder that for all corporate tax registrations, and if the client is registered for VAT, then the VAT documents or the documents uploaded for VAT registration in the MRA tax portal have to be the latest updated documents. None of the documents such as trade license, passport copies of the owners, managers, directors, or the Emirates ID copies should be expired. They have to be up-to-date documents, and then only the corporate tax registration will accept those documents, because corporate tax, usually when we do the corporate tax registration, it will pick up all the documents from your VAT registration. So if those documents are not updated, then your corporate tax registration might get rejected or might get delayed as well. So make sure the documents in the VAT registration are all up to date. So that's from my side. Thank you.
Thank you, sir. So with that, I think let's move on to the Q&A session. So we have certain questions that the participants had initially raised when they registered for the webinar, and I think most of them have been addressed during the webinar. One of them, which we can take up now, is regarding the startup phase. So if a company, let's say, is a manufacturing company, it's intending to do a qualifying activity, But let's say it has just been incorporated, so there's no revenue during the first tax period. So that would mean that it's not generating any qualifying income technically then in that period. So would that kind of a company be disqualified because there's no revenue during the first tax period, or can it still claim the QFZP benefits?
Kapil, you're on mute.
Yeah, sorry. So in this scenario, since the company is newly incorporated and is not generating any revenue, it will not be. It can be. It can claim. It will not be disqualified from claiming the QFZP benefit, since unless and until it has any non-qualifying revenue in its books of accounts, till that time it will be able to claim the QFZP benefit. Yes. So just because it doesn't have any revenue or it is in just initial phase, it will not be disqualified.
Thank you, sir.
Just to add to this, what Kapil said is very valid, that it will not be disqualified. However, that company also will need to see what are their future projections going forward. Will they meet all those conditions of QFZP going forward also when they start generating revenue, and that de minimis specifically QI, non-QI computation, and what it would be. So will they be still future also when they start generating be entitled to claim QFZP or not? And what is the benefit arising out of that? Vis-a-vis, if you, let's say, opt for a normal tax regime, then because what happens in manufacturing entities, like, long gestation period, initially you have a lot of costs incurred and you might have losses in those periods. Now, if those losses are sizable, then sometimes it could be beneficial that you opt for a normal regime, carry forward the losses, and then future, you set off against the future profits. So again, I think, that computation projections and all that should be seen for the next 5 years, and then take a call on that. Should you actually opt for QFZP or you should opt for a normal regime?
Thank you, sir. We have a question on city registration. If the license has expired in Jan 2024, but liquidation starts thereafter, now since the license is expired, would the FTA still allow to register for city?
So since the license has expired, but the liquidation has not been completed before I assume that since it has expired in Jan 24, the liquidation process would be ongoing still, and the first corporate tax period would have been started. So in that scenario, the company will have to register for corporate tax. It is very clear guidelines from the FTA, and yes, the FTA will allow to register for city. We have had an example or a case in one of our clients wherein the FTA has approved the CT registration for such companies. You can always contact us if in case you have any such company, and we'll guide you further on that.
Thank you, sir. There's a question on distribution activity. If a DMCC company exports to a customer based in the UK, would that be qualifying income?
So if a company is based in DMCC and it is making any exports to the UK, see, firstly, DMCC is not a designated zone. So if you are looking to take the benefit of the distribution activity, you will not be able to claim that. However, there is another activity called as the trading of qualifying commodities, and over there it is important that the commodity should be traded on a recognized stock exchange. So it will have to be seen whether the polished diamonds are traded in any recognized commodity exchange or not. If that is the case, and I think this since the example asked is polished diamonds, it might not be a rough diamond, or it might not be in a raw form. So even for that will be a challenge in claiming the benefit. So the challenge number one would be it should be traded on a recognized commodity exchange. Challenge number two would be whether that diamond is in a raw form, or it is, since the word polished diamond is mentioned, it might not be in a raw form. So that would also be a challenge in claiming the benefit under that activity.
Thank you, sir. We have another question which is slightly related to this. If a company is trading in equities, commodities, and indices only over different regulated exchanges across the world, as short-term trades or day trades, would that be taxable or would it be qualifying?
No, so it would be taxable. It will not be qualifying, because in order to have to claim the benefit under the holding of investment qualifying activity, it should be, the investment should be held for a minimum period of 12 months. So if only if that criteria is satisfied, only then you will be able to claim the benefit under that activity.
Thank you, sir. Another question on CT registration. We have a company whose license has been cancelled in 2020. However, it was VAT registered and the deregistration is still under process. It's at the pre-approval stage. So, and the tax audit is going on. So are they required to register for CT or not?
So I understand that the license is cancelled in 2020, which would mean that the license is cancelled per se from the registers of the regulatory authority. If that is the case, then there is no requirement to register for corporate tax purposes, even though the compliance with respect to VAT deregistration and tax audit is ongoing under the VAT laws. That is different, that is separate. That cannot be mixed with the CT compliance over here.
Thank you, sir. We have a question on service income. If a company generates commission income on high sea trade, will the commission income be qualifying for free zone purposes?
No, so if the company is doing a high sea trade and it is earning a commission income on that as well, so commission income will be considered as a separate activity altogether, and it will be considered as a non-qualifying activity and a non-qualifying income. Although I'm assuming the other conditions with respect to the distribution activity are being satisfied, and the distribution activity also mentions about some certain ancillary activities to be considered as a qualifying activity as well, but the generation of the commission income would not be called as ancillary activity, and it will be considered as a separate activity.
Thank you, sir. We have a question on natural person. If the person is running an FZE company and the revenue of the company exceeds 1 million AD in a Gregorian calendar year, is the person required to register under?
So if the revenue is under the FZE company, even and in under FZE companies there are single shareholders, so you do not have to see the 1 million criteria under this scenario. If it is an FZE company, then you have to straight away register for corporate tax. So I would just say that any company or any entity registered within the UAE have to register for corporate tax irrespective of their amount of turnover or profitability or the business activity that they are conducting. Only natural persons or sole establishments have to look into the 1 million criteria. Other than that, no one, including even offshore companies as well, as rightfully pointed out by Prasad.
So I just like to add this, that FZE companies, though they are free zone establishments, are not considered as natural persons or sole proprietorships for city purpose. So for FZE, we don't take that 1 million criteria into consideration, and all FZE companies have to register irrespective of their turnover.
Thank you, sir. We have a question which was perhaps addressed during the session. What is the deadline to register for corporate tax for an LLC company?
So for an LLC company, it would depend upon the license issuance date of the company. We have prepared a chart for that, and that is included in the presentation. You can look into that. If any queries, you can always contact us and we'll help you further.
Just one thing, Jyotika, I would like to add here on the commission income on high sea sales, which was mentioned. Now, see, there are two scenarios. There could be one, of course, what Kapil said is right, that it would not be a qualifying income because assumption is that the person paying the commission, the client or the customer who is paying the commission is not a free zone person or based overseas. However, if it is a free zone person who is basically the customer and to whom, so a free zone company raising invoice, service invoice on another free zone person, where that free zone person is carrying out the high sea sales directly and then they are paying commission to this. There is a possibility that could get covered under qualifying income. Of course, again, subject to fulfillment of some conditions. So that needs to be looked at primarily, that who is the customer, who is the, where is that customer based in, and is that customer the actual beneficial recipient of those services or not? So that will need to be looked at. I think there were two more questions in between. I think that we are merchant trader registered in DMCC. Mostly transactions are from one country to another country. Since DMCC is not a designated free zone, is it better to go for designated zone for getting exemption, or any other mode to get benefit or exemption of tax?
Yeah, so if it is a merchant trader registered in DMCC, DMCC is not, as you rightfully said, it is not a designated free zone. So at least from DMCC doing a distribution activity, you will not be able to claim that benefit of the QFZP. If there is a company who is doing an activity, distribution activity from a designated zone, then it will have better chances, considering the other conditions are fulfilled, then they can claim the benefit. Yes.
Thank you, sir. Next question is again related to distribution. In case of sale of goods as a qualifying activity from designated zone to an end user in mainland or in free zone, will the income be considered as qualifying income?
No, so if it is an end user, then it will not be considered in the mainland, then it will not be considered as a qualifying activity. However, if you are selling the goods to a free zone person, the only condition that you have to see is that that free zone person has to be a beneficial recipient, and it should not be a excluded activity. So even if it is a end user in a free zone, to the condition that it should be a free zone company, then you can, that amount of income will be a qualifying income. After that, you have to calculate your de minimis, and if finally the de minimis is being satisfied, then you can claim the benefit of 0% tax.
Thank you, sir. The next question is connected to qualifying commodities, whether rough and polished diamond and golden diamond jewelry would be considered as qualifying commodities or not.
So as I mentioned with respect to diamond in the earlier question, or in order to claim the benefit of qualifying commodities, there are two aspects. One is the commodity should be in the raw form, or only minimum polish or minimum polish would be required, or minimum processing should be done in order to get it traded on a recognized commodity exchange. So as far as rough or polished diamond is concerned, again, I would repeat that there will be two challenges. One is whether the diamond is traded on a recognized commodity exchange, and second, whether the diamond is in a raw form or not. If it is polished or substantial processing is done on the raw diamond, then it will not be considered as a qualifying commodity. As far as gold jewelry is concerned, gold bars or raw gold is traded or on a recognized stock exchange, then if the trading or business is done on that raw gold, then yes, it would be considered as a qualifying activity. But if you're speaking about gold jewelry per se, which is just like we talk on a common scenario, which is necklaces on bracelets or something like that, then it will not be a qualifying commodity.
Thank you, sir. We have another question regarding natural person's income. If a natural person has invested in different funds and gets investment income over a period of time, which could be in the form of long or short-term capital gains, and is more than 1 million dirhams per year, would they be taxed as well in his personal capacity?
No, so in case of natural persons, and if it is an investment income, investment income is not considered in the 1 million threshold. It is considered outside the 1 million threshold. So any amount of investment income, if you have, that will not impact your taxability as far as corporate tax is concerned. However, if you have any other business income of more than 1 million in the Gregorian calendar year, you will have to register. But yes, if the question is about investment income, it will not be included in the 1 million bracket.
Thank you, sir. I think we have a question that was addressed earlier, but if we could just emphasize on whether the income of a free zone establishment makes the natural person owning it liable to register for corporate tax, Or if you could just mention what are the instances when a natural person has to register for corporate tax?
So there are in UAE you can have single person company or single person free zone establishments as well. So for corporate tax purposes, such single person companies or single person free zone establishments are not considered as natural persons, even though they are ultimately owned by a natural person. They are not called as natural persons per se, which have to be considered and the 1 million threshold. These are considered as corporate entities, companies, and for them there is no 1 million threshold, irrespective of whatever amount of turnover or business activity that they are doing. They have to register. As far as natural persons are concerned, if they are doing any business under their own name, or they have their own trade license, under which their own name is being mentioned, or they have a sole establishment. There is a legal type called sole establishment. If it is a sole establishment, then under these two entities or these two businesses will have to be considered under that 1 million threshold. And if their turnover is more than 1 million, they will have to register.
I'd just like to add in this. I think if we go for that FZE question initially, so an FZE has to register. The owner of the FZE does not have to register. Okay, so the FZE will register for corporate tax. The owner does not have to register. Owner might have to register only if it has some other activity, or if it is doing some other, it has some other business activity, or it has some other sole proprietorship in the mainland, and where the turnover from that is more than 1 million, then that owner would register. But otherwise, if FZE will take a corporate tax registration, the shareholder of the FZE does not have to register on behalf of the FZE.
Thank you, sir. I think that's it for the questions that have been raised in the Q&A. We could wait for some time for any more questions, or if any participant wants to speak, they can raise their hands.
Also, if you wish to receive the presentation, already our colleague has posted on the chat the email ID on which you can send in a request, and we'll be glad to share the presentation of today's session. As well as our this recording will go live on the YouTube, and the channel has already been also posted on the chat, so you can check that out.
I think one hand is raised.
Yeah, I think unmute. Hi, Regan. You can unmute and speak. Hello. Regan, you can unmute yourself and ask your question. Okay, while he is still, I think, trying to unmute, or maybe I think he has raised his hand by mistake. We'll wait for some time. But in the meantime, I just would like to highlight, see, selecting, no doubt, 0% tax benefit is a big benefit, and especially in cases where the profits could be substantial. However, you need to ensure that there are a lot of conditions that needs to be fulfilled. Primarily, substance is one of the major conditions. You need to have substance in the free zone from where you are operating. You need to ensure arm's length pricing and transfer pricing, because as you have seen, distribution activity has been quite generously, in the clarification given that even buying from UAE and selling to UAE gets covered under distribution and does not need to physically move to a designated zone. So you need to ensure that if you are transacting with group companies, you please ensure that you follow the arm's length pricing, and thereafter ensuring qualifying activity and de minimis. This is the most important and challenging aspect, I would say, because you need to classify your revenue into various buckets and then work out the calculation of QI, non-QI, and de minimis, which is going to be quite a challenge. And there are quite stringent conditions on those which needs to be fulfilled. So you have to ensure that you meet that, because if you do not, then obviously you get disqualified for 1 + 5, 4 years. So total 5 years. Yes, Sandeep Ji Mishra, you have raised your hand. You can ask a question.
Sir, I have a question. Like we are in the process of establishing a company in UAE, and we have selected the IFC zone. What I understand that there is a tax rate is either 0% or 9% tax rate is applicable for the companies who are going to be established in the IFC zone. That depends on the qualifying income and non-qualifying income. Correct. So my question is, and there is also threshold limit that if the profit is less than AED $375,000, AED 375,000, then there is no tax. Correct. So my question is, if somehow the company get registered in the IFC and they have some non-qualifying income, and the profit at the year end is less than 375,000 AED, then there is no tax. Correct.
Yeah, see, that depends on now one DIFC, whether you can claim free zone benefit or not. You have to see what activity you are into. Does it fall under the qualifying income, and it should not be excluded activity. So, and you have to fulfill all those conditions of substance, ambulance, pricing. However, if you feel that no, your revenue is anyway less than 3 million dirham, maybe annually, you may opt for normal regime and claim the small business relief. Or if your profit is less than 375,000 dirham also, or maybe let's say even if it is 500,000 dirham, for example, up to 375,000, if you opt for normal regime, up to 375,000, you don't pay anything, 0%, and above 375,000 profit. So on the differential of 125,000, you would pay 9%. So your effective tax rate is then lower.
Okay.
So you have an option. You have an option, obviously, but as the point is that claiming free zone benefit is definitely going to be a challenging task, and you need to ensure compliances to the full extent.
Thank you, sir. One more question, sir. In UAE, is there any withholding tax for anything, any amount remitting to outside UAE? Say, for example, if a company sitting in UAE remitting money to India for any services, so is there any withholding tax applicable there or not?
UAE does have withholding tax provisions. However, they have not the current rate of withholding tax is 0%. So currently, no, practically you don't have to pay anything or deduct anything as withholding tax. But yes, the withholding tax provisions are there. So yes, whenever the 0% is raised to any other percentage, yes, deductions will need to be done.
Okay. Thank you, sir. Thank you.
Thank you. Okay, I think we can probably, what we'll do is I'll just share our last slide which has the contact details. So if anyone wishes to connect with any of us, you can always contact us on any of these email IDs. Either me on vipul@vipulkothari.com or Prasad on prasad.bonde@kaa.e or Kapil on kapil.shet@gbsci.com. I've also posted that in the group chat also, so you can pick up those email IDs from there also. Thank you very much for joining in today, and we'll look forward to receiving your feedbacks and comments, and you're more than welcome to connect with us for any clarifications and doubts that you would have. And time is now, I would say right, but it is past the time. You need to, as I mentioned, ensure classification at the source. So your revenue needs to be classified at source, even your expenses in terms of deductible, non-deductible, partly deductible needs to be classified at source when you're doing the accounting. You can't sit down at the end of the year when you file your tax return and then start segregating, because that will be too much of a trouble and pain. So this is most important part, has to be started now, and to avoid any issues later on when you're filing the return. Thank you very much. We can end the session, I think, since there are no questions. Thank you everyone for joining in today. Look forward to receiving your feedbacks and comments. Thank you.